Welcome back. We're heading into the pre-opening rates. Looks like it's going to be a good one this morning. But let's put focus now on the oil marketing companies. IOC, BPCL, HPCL were all up and about yesterday, following a bullish note from HSBC. Harshvardhan Dole, the Senior Vice President, Institutional Equities at IIFL, joins us now to talk more about that. Harsh, thanks a lot for being with us on the channel. First, just give us this overarching theme, right? What is the reason for the rally in the oil marketing companies and how are you positioned here?
So I think clearly there are two key reasons why the companies or the stocks are doing fairly well. One is there has been consistent earnings upgrade for the oil marketing companies during this year. And the upgrade has been on account of a greater visibility as the quarter goes by. Perhaps at a point in time, the street was particularly concerned that the pricing of auto fuels will be curtailed and there will be huge losses on the marketing side. That has not played out. On contrary, despite a very sensitive period in terms of politics, the companies have made record high profits and looks like there is a possibility of further earnings upgrade. And looks like, the street has finally taken a note of that, for which we are seeing consistent earnings upgrade and essentially rally in the stock prices. So we've always maintained a view that OMCs offered a very asymmetric payoff, i.e. The downside is fairly low, and if crude oil remains benign, the multiples can, multiples can re-rate materially, which seems to be, sort of playing out in this current rally.
I mean, and who would have thought, right? For two wars in regions which are oil producing, US economic growth, which is so strong, and oil prices are at the lower end of their range in that sense. On the other hand, oil marketing stocks usually sulk going into a election cycle, Harsh. Morning, Prashant here. That's not been the case this time. Do you think that's something to worry about going forward over the next, all the way into the general elections, or not really?
Prashant, see, it will be unfair to judge what essentially policymakers might do in a month or a couple. Essentially, but when you look at these companies and their fair value, let's assume a normalized earnings scenario panning from FY25 onwards, i.e. A Singapore GRM of anywhere between $6 to $7 and a normalized marketing margin, assuming that FY25 there are no political disruptions. In that case, all the three companies are trading at EV/EBITDA of around 5 to 6 times and a nearly double-digit dividend yield, even now after the run-up. So the risk-reward is extremely favorable. And if oil remains weaker than what we are expecting, or the Singapore margins tend to surprise on the upside, the dividend yield become more and more compelling. So I will not want to pass a judgment whether there will be a harakiri in the next month or so or a couple. But let's assume a fair normalized earnings scenario in FY25, basis which these stocks are extremely, extremely cheap.
Harsh, we'll get back to the OMC discussion, but I wanted your view on Tata Power. The stocks saw a good move actually, and they put out a release. They're talking about doubling their profitability as well in the next few years, focus on distribution, on clean energy as well. How much of it is in the price? Would you be a buyer at these levels, or would you wait for a better opportunity?
So we attended the analyst meet yesterday that the company conducted, and we are pleasantly surprised by the aggression that the management has put forth. And I really appreciate the kind of roadmap that the company has laid over the next few years. Probably it is the only company which is painting a green picture in a formidable way. They are not talking about thermal either which ways. That's quite commendable. But having said that, I think some part of these aggressive plans seem to be in the price. And I'll be more comfortable, buying the stock at maybe 10 to 15% decline in the stock price. Rather than chasing the stock at current market price, I would prefer to buy it on declines.
So prefer to buy Tata Power on declines. Got that. Since we're talking about this entire space, there is a big listing today, the green financing company IRDA list today. You don't track that particularly, but this whole renewable energy space is getting a lot of focus, right, Harsh? So from the universe that you track, where do you still see some valuation headroom?
So across the renewable companies, I think companies like NTPC, who are scaling up capacity sensibly with some margin of safety while bidding the projects, will emerge key beneficiary. Some of the financing companies like maybe IREDA or PFCREC will also tend to benefit. However, some of these unlisted players, smaller EPC companies, will actually tend to be biggest beneficiaries of the capex cycle. One has to be mindful of the governance and the balance sheet, but I think their non-linear revenue model is something which can play some of these companies from a risk-reward perspective quite attractively.
Okay, all right. We'll leave it at that, Harsh. Thanks a lot for joining in. Appreciate your thoughts. That's the word coming in on a couple of sectors from IIFL.